For the past few weeks, most of the conversation has been about fear. People are asking if Bitcoin is headed much lower, whether altcoins are finished, and if this cycle is already over. But underneath the headlines, something very different is happening. Bitcoin whales are accumulating at one of the fastest rates ever recorded. Large XRP holders are quietly pulling coins off exchanges. Ripple just announced another institutional partnership. Countries continue rolling out crypto regulations, and even traditional economic indicators are starting to hint that conditions may be improving. None of these stories guarantee higher prices tomorrow, but when you step back and connect them together, they paint a picture that looks very different from the one dominating social media. So today, we're going to break down everything happening behind the scenes, and why some of crypto's biggest players appear to be preparing for something the average investor still isn't expecting. Nothing in today's video is financial advice. Always do your own research before making any investment decisions. Welcome back to Ledger Pulse. If you're looking for the biggest developments in crypto explained without the hype, you're in the right place. Today we got a lot to cover, from Bitcoin whale accumulation and XRP infrastructure expansion to new regulations around the world and what macroeconomic data could mean for the months ahead. Let's get into it. One of the biggest stories this week came from on-chain data. According to multiple analysts, Bitcoin whale accumulation has surged to levels we've never seen before. One report estimates that large holders accumulated roughly 270,000 Bitcoin while prices traded around the $59,000 range. That isn't a small purchase. It's billions of dollars flowing into Bitcoin during one of the most uncertain periods we've seen this year. What's especially interesting is when this buying happened. Retail sentiment has been extremely cautious. Many investors have been waiting for lower prices. Some are expecting another major correction. Meanwhile, the largest market participants have been steadily increasing their exposure. This isn't proof that the bottom is already in. Markets can always move lower. But history shows that institutions and long-term holders rarely wait for perfect certainty before accumulating. They tend to buy while confidence is low. Retail investors often wait until optimism returns. That's one of the biggest psychological differences between professional investors and the average participant. Professionals focus on value. Retail often focuses on recent price action. Whether Bitcoin immediately rallies or not, the size of this accumulation tells us one important thing. Large investors clearly see enough long-term value to continue buying despite the uncertainty. Matthew Hyland pointed out something that caught a lot of attention this week. Bitcoin dominance has officially printed another death cross. Normally, the words death cross sound extremely bearish, but context matters. This is only the third confirmed Bitcoin dominance death cross in more than 5 years. The previous ones appeared in 2016 and again in early 2021. Instead of marking the beginning of weakness for crypto overall, those periods eventually lined up with stronger performance from altcoins. Now, that doesn't automatically mean history repeats itself. Markets never move exactly in the same way, we know this. But Bitcoin dominance measures Bitcoin's share of the total crypto market. If that percentage begins falling, it often means money is rotating into Ethereum, XRP, and other altcoins. It's something worth monitoring over the coming weeks because it could become one of the first signals that broader market participation is returning. Another trend that's becoming harder to ignore involves XRP. New crypto quant data suggests large holders are moving XRP off centralized exchanges at an increasing pace. Why does that matter? Coins sitting on exchanges are generally easier to sell. Coins being withdrawn typically suggest holders plan to keep them for longer. Think of it like moving money from your wallet into a long-term savings account. It doesn't guarantee you'll never spend it, but it usually means you aren't planning to use it immediately. According to the data, whale activity has increased much faster than retail participation. Large holders appear to be positioning themselves while many smaller investors remain cautious. Again, this doesn't predict short-term price movement, but it does show that some of the largest players in the XRP ecosystem are acting very differently than the overall market sentiment would suggest. One thing Ripple has consistently focused on isn't daily price action, it's infrastructure. This week, Ripple announced its integration with OpenUSD as a day one partner. The goal is to improve interoperability between stablecoins and institutional financial systems. That may sound technical, but the idea is actually simple. Today's financial system is fragmented. Different blockchains, different stablecoins, and different networks don't always communicate efficiently. Institutions want infrastructure that allows assets to move between these systems securely and reliably. That's exactly where Ripple continues investing. At the same time, another announcement showed Wyden's trade orchestration layer integrating directly with Ripple custody. That creates a workflow combining institutional trading with bank-grade custody in one environment. These aren't announcements designed to generate excitement on social media. They're the kind of infrastructure upgrades institutions typically care about before large-scale adoption happens. Infrastructure usually gets built before usage scales, not after. Another interesting update came from Brett Mullen of the XRP Ledger Foundation. He emphasized that institutions don't just need speed. They need secure, compliant, and decentralized infrastructure. He also highlighted how XRPL's native auto-bridging could eventually connect tokenized assets, stablecoins, and other financial products through XRP liquidity. Think of it like building highways. Before millions of vehicles can travel efficiently, the roads have to exist first. Crypto infrastructure works much the same way. The headlines often focus on token prices. Meanwhile, developers continue building the systems that could support much larger transaction volumes years from now. That's a much longer-term story than most daily market discussions. While prices fluctuate, regulation continues advancing around the world. Italy has now approved its first licensed crypto portfolio manager under the MiCA framework. Instead of simply offering custody services, firms are beginning to actively manage digital asset portfolios within a regulated environment. Taiwan also passed legislation establishing a regulatory framework for crypto exchanges and stablecoin issuers. These developments matter because institutions generally prefer operating inside clear legal frameworks. The more countries establish consistent rules, the easier it becomes for larger financial firms to participate. Regulation isn't always exciting, but it often lays the groundwork for future adoption. Another interesting statistic came from CoinDesk. The crypto industry has reportedly become one of the largest sources of corporate political spending in the United States during the current election cycle. Whether people agree with that or not, it highlights something important. Crypto is no longer a niche industry. It's becoming a sector that policymakers increasingly pay attention to. As more legislation involving digital asset reaches Congress over the coming years, the industry's influence will likely continue growing alongside institutional participation. Another chart that caught my attention wasn't even from the crypto market. It came from manufacturing data. The ISM Manufacturing PMI recently recorded one of the tightest 2-month Bollinger Band squeezes on record. For anyone unfamiliar with Bollinger Bands, they measure how much volatility exists in a market or economic indicator. When the bands become extremely tight, it often means a larger move could be approaching. In this case, PMI has started pushing higher. If manufacturing activity continues improving, it could signal broader economic expansion. Why should crypto investors care? Because liquidity and economic growth often play major roles in risk assets like Bitcoin and cryptocurrencies. It's still far too early to declare a new economic cycle, but it's another data point suggesting the broader backdrop may be improving instead of deteriorating. When you put all of these developments together, a consistent pattern starts to emerge. Bitcoin whales continue accumulating. XRP whales continue withdrawing coins from exchanges. Ripple keeps expanding institutional infrastructure. Countries continue creating clear regulatory frameworks. Economic data is showing early signs of improvement. None of these developments guarantee that prices immediately move higher. Markets rarely move in a straight line. Volatility is always part of crypto, but long-term trends are often built quietly before they're reflected in price charts. That's why looking beyond daily candles can be so valuable. Sometimes the most important signals aren't found in the price itself. They're found in what institutions, developers, and governments are doing behind the scenes. And right now, those signals continue pointing toward an industry that's still expanding despite all the short-term uncertainty. If you enjoyed today's breakdown, make sure to hit the like button and subscribe so you don't miss future episodes. I'd also like to hear your opinion. Which story do you think matters the most right now? Bitcoin whale accumulation, Ripple's institutional expansion, or the global push toward crypto regulation? Leave your thoughts in the comments below. Thanks for watching, and I'll see you in the next one.